So I've recently been spending quite a bit of time thinking about my Meituan investment idea. Rightfully so, due to a myriad of different reasons. And a phenomenon that I've actually realized is that the time and effort spent on a particular investment idea is inversely related with the stock price or the price action of the chart. The more the stock price goes down, the more you have to stress test your thesis and to think about your subsequent decisions on whether you continue holding, do you add more, or do you sell. But that's besides the point. I think specific for this video, it's not so much about my own personal original analysis, but I wish to point you towards two Wechat investment analysis article that was pointed my way by one of the viewer. Huge shout out to Anderson. The article was in Chinese. I try my very best to translate it into English and to sieve out some of the important insights. And I'll have a very small conclusion of how I think about Meituan versus Alibaba today at the later part of this video. All three companies in this whole food delivery war has recently reported their Q2 results. So for JD.com, their overall Q2 operating profit has went down to negative 900 million, and on a year-on-year basis, previously was 10.5 billion. So operating margins has also swung from 3.6% to negative 0.2%, and the food delivery segment itself posted an operating loss of 14.8 billion RMB. So their daily delivery order volume was estimated to be roughly 15 million daily orders and down from the 25 million daily order peak. So Q2 free cash flow was still positive at 22 billion. Trailing 12 month, it's at 10.1. I think generally for all three companies, it is in a very concerning downward trajectory. So for their balance sheet, their cash and cash equivalent, 223 billion RMB. For Meituan, their Q2 operating profits is down 98%, basically evaporated. You can treat it as negative in the next coming quarter. Their core local commerce revenue, even though it's up 7.7%, but their margin fell from 25 to 5.7%. Their operating margin overall is also down from 13.7 to 0.2%. That's it. I think in terms of a business fundamental economic matrix wise, monthly active users actually exceeded 500 million users, and their peak order volume exceeded 150 million orders. So their cash flow from operations was 4.8 billion previous quarter, and the cash and cash equivalent 171 billion. Moving on to the largest juggernaut out of this space, Alibaba, their adjusted EBITDA is negative 14% to 38.84 billion. Not a very good comparison across the three companies, but we work with what we have. Their customer management revenue, which is their advertising arm, is up 10% year on year due to mainly an increase in take rate. Their GMV actually increased in lockstep. That I'm not too sure. In fact, I don't think so. So it's more so about them increasing their take rate and pushing up the margins rather than a natural growth from top line increase. So in August, actually their Taobao flash sale reached a peak of 120 million daily order, and their current average daily order is sitting at around 80 million. So their cash flow from operations was at 20.67 billion. You can see that Alibaba is still the most stacked compared to JD and Meituan. They are the largest conglomerate. They have other businesses that are also churning out cash. And their free cash flow did see a net outflow of $18.8 billion, mostly due to the capital expenditure on the AI and cloud infrastructure. In terms of balance sheet wise, it's also the most healthy. Cash and cash equivalent, 585 billion, more than JD and Meituan combined. So after looking at some of these headline numbers, what does it actually mean for the company specifically? So do you know that the $2,000 sitting in your bank account today could be working way harder for you? And Longbridge, a MAS licensed broker in Singapore, has a promotion running right now. And if you sign up with my link below and deposit just 2,000 Singapore dollars, here's what you get. A 6 plus 6% per annum interest boost on your first $2,000 for 90 days, exclusively through my link. And that's $60 in interest if you park the cash in their Cash Plus product. On top of that, you get an additional $18 cash coupon just for signing up and depositing. And if you hold your funds for 30 days and complete 3 buy trades, you'll receive half an Nvidia share worth about roughly 100 Singapore dollars today. And add that up and you are looking at around $178 in value on a $2,000 deposit. And that's 8.9% before you even start investing. So you also enjoy lifetime commission-free trading for US, Hong Kong and Singapore stocks. 0 platform fees, and if you've got more capital, rewards can go up to $800 in total just for getting started. So don't miss this out. Click on the link in the description below to grab your exclusive rewards. And thanks to Longbridge for sponsoring this video. So there is some nuances or colors that we wish to add here is that I think in Q2, only Meituan and JD participated throughout in this subsidy war. Alibaba actually joined in much later, and I believe they only came in mid of May. So technically, they only burned capital for 1.5 months. So the numbers naturally would look better. So in that time frame, it's estimated that JD lost roughly 13.5 billion, Alibaba threw out 15 billion, and Meituan sacrificed about $10 billion. And I think the general street consensus is that the battle in Q3 will be even more brutal than what we see in Q2. So spending is estimated to be at least double. So for JD.com's numbers, from a small negative, it will go to a large negative. Meituan from break even will go into negative. And for Alibaba specifically, I think free cash flow is already negative. But if you look at it from an operating cash flow or operating margins perspective, I think it's still positive because they have a very large base. But that also means that investors is definitely in for a while, right? JD.com has chosen to temporarily withdraw from the current subsidy war. So in that two Wechat articles, they basically revolve around this idea called 占损比, or if I can translate it, it's kind of like a battle loss ratio. So this is an interesting metric that they came out to judge who's actually winning a subsidy war by comparing how much profits each side actually burn to gain or defend the market share through a very competitive landscape. So looking at the amounts being spent here, Meituan 10 billion, JD 15, and Alibaba 13. The framing here is that Meituan's battle loss ratio is 1 to 2.8 or 3 times because it's $10 billion in negative profits versus $28 billion combined between Alibaba and JD. Truth be told, Meituan is the only so-called market leader here. And JD and Alibaba is just trying to chip away at Meituan's market share. And just judging by surface numbers now, actually it looks still okay. In a way, I think Meituan is spending much lesser than their rivals trying to defend its market share. Hence, you can kind of draw the conclusion that the defense was pretty much cost effective. And just a few sanity check in terms of numbers here is that by end June, the Taobao flash sale daily orders rose from 20 to 50 million orders despite the heavy support. And for the full Q2 period, all the different rivals burnt huge amount of capital, but their order increase is only a modest step up. So this current 1 to 3 ratio is rather acceptable. But in the later period in Q3, which is from July to August, Alibaba pushed even harder by pressing on the gas pedal with an extra 50 billion yuan commitment, and their daily order volume actually bumped up to roughly 18 million daily orders per day. And we need a lot more numbers to ascertain the new ratio. So it's expected that Meituan's profits in Q3 and Q4 will basically be extremely ugly, and they are probably going to be in the north or in the south of 10 to 20 billion RMB operating loss. And more importantly, I think in the first article, the author actually asserted that Alibaba was trying to play some of these mind tricks here. So he cited 3 main conditions. Firstly, it's on time illusion. Because the financial data that Alibaba announced during the earnings was for Q2, which is April to June. But many of the communications in the earnings call itself, they talked a lot about the market situation in August back then, which they have basically stepped up a lot of their subsidies. We are not sure how much of the capital earmarked was already deployed. Hence, it's not necessarily a very fair comparison. And it gives off a wrong impression that Alibaba only deployed so little capital to get such huge results. So that 1 to 3 battle loss ratio put out by Meituan is very healthy for now. So we need to see the reported figures again in Q3. And the second factor that they put out was that Alibaba's positioning for their Taobao flash sale was the avoidance of discussing efficiency in favor of scale. So there are a lot of storytelling. I'm talking about the $1 trillion RMB total addressable market, looking at the scale, I'm looking at the cross-pollination and how the entire conglomerate can work hand in hand together to generate even more profits down the line. The writer actually argues that all of these is pretty meaningless and only an accurate battle loss ratio comparison is useful, at least for now in the food delivery or instant retail space. So at its core, especially in this food delivery space, efficiency is everything because it determines your unit economics, it determines your overall profit profile, and it determines how much you can generate in the longer term. So you can have all the scale you want in the world, but if it's being artificially propped up by subsidies, highly inefficient protocols and operations, and if the company don't generate any profits, it wouldn't accrue to shareholders at the end of the day. And the third factor is really more about the building stories and envisioning the future to guide reality. So many of what Alibaba actually talked about during the earnings call, especially with all this total addressable market and the prospects of visions, is nothing more until it can be realized. And the conclusion coming out from the first analysis piece was that regardless of how bad Meituan's financials will look in the upcoming Q3 and Q4 earnings, if they can achieve a 1 to 2 better loss ratio against Taobao, they can win. If they can achieve 1 to 3, then there's no doubt that they will definitely win if it to drag out this entire war, and Alibaba will stop burning capital. And if they can only achieve 1 to 1.5, then Meituan is in danger, as the tug of war will probably continue, and it comes down to attrition and who can persevere longer. And in other words, if you give any sliver of hope for Taobao's management team that their flash sale or their Ele.me business can make a comeback while not burning a lot of capital to be efficient in grabbing market share, then yes, I think this entire war will be a very long dragged out one. So he also did assert that investors are overly optimistic about Taobao's flash sale business, and investors should focus just on the better loss ratio. And even if Meituan's better loss ratio is ideal, their share price will probably look very ugly in the short term, and it's inevitable due to the very bad numbers that's going to come out in the coming 2 quarters ahead. So the second author's conclusion is a little bit more nuanced and developed here. So you can very easily identify many business advantages of Meituan over Taobao. So you have your customer perception, consumer habits, scarcity of high quality supply, end-to-end integration and data analytics, cost efficiency per order, operational mode across geographies, so on and so forth. But the main point is that the nature of the war has changed. It's no longer a business war, it feels very much like a capital war. In the past, Meituan can earn 1 to 150 yuan per order, and Ele.me lost 50 cents to a yuan per order. But Alibaba gives off the vibe saying that they really don't care about casualty numbers because instant retail is $1 trillion future annually. So in that sense, they are creating a story to justify the capital burn to shareholders. And in that specific transition period, you can throw logic out of the window. And for Alibaba, they have roughly 580 billion RMB on its books, and its e-commerce can earn $100 billion more per year than Meituan and JD combined. Of course, they have 2 other money-burning battlefields in e-commerce and in AI, which they plan to continue investing heavily as well. Therefore, I think the plan for continuous loss leadership to lock in customers, then optimizing for delivery, is still on the table for at least 2 more quarters, which Meituan can only be forced to dance along. So based on a former Meituan executive remark, it takes roughly half a year to cultivate consumer habit. And if there is a defense, the time taken is a lot longer. When the instant retail war ends really depends entirely on when Alibaba stops. And I think in the very near term, at least out into the 2 quarters, I don't think it will stop. It's at least out into 2026, based on current consensus. And also based on my personal gut feel. They have to press on the gas pedal until 11/11 Singles Day come to kind of justify or to show a very nice report card in that sense. So there was an adjacent discussion around the idea of value investing and what investors should think about. And the second author did put out a case that many people think value investors equals to long-term investors who buy and never sells. He claims that this is only the form of value investing, not the essence. Because the idea of not selling is premised on the company's fundamentals remaining unchanged. And there are 3 factors on when you should sell. When fundamentals change, when price becomes too expensive, or when there are better opportunities elsewhere. So for the author's case, he actually stopped buying Meituan at roughly the $130 range when Alibaba went all in into this instant retail war. And this basically introduced a new variable into the system, and he even partially sold out of his Meituan position. So his conclusion is that 3 to 5 years later, these super platforms will all become very valuable. It's just that market sentiments today is excessively pessimistic, thinking that Meituan is going to collapse. So even if Meituan loses $10 billion in Q3, it couldn't lose it all even if it kept losing for 4 years. So there is a pretty long runway ahead for them to continue competing for market or defending the market share. And the specific base case that he's guessing here is that once daily orders actually reach some sort of a 50-50 split with Alibaba, the better loss ratio between the two will widen further. So Alibaba's money don't come easy too. So when the same price paid actually fails to bring in an increase in order, they will stop pressing on the gas. And interestingly, I think on a side note here, Pinduoduo holding on to $400 billion on their balance sheet without paying a dividend is actually a huge deterrent to Alibaba. When both sides actually possess nuclear weapons, wars often don't get fought. So his view remains that competition is a stumbling block to profits, and the best companies are those without competition, such as Meituan and Wechat. Ultimately, even if Meituan is beaten long-term to a 50-50 split, and the unit economics actually depreciate from the 1 RMB per order to 50 cents per order, as long as it holds a 50% market share, earning 20 to 30 billion per year is still very doable. That said, he's not participating simply because Alibaba has too much money, and the fight is going to be bloody. So here's my own personal view after understanding from different perspectives. I think there is an inherent bias here, especially against JD and Alibaba, and it's not new, especially for those of you who consume Chinese mainland related investment analysis content. A lot of people tend to not like JD, Baidu, Alibaba. A lot of them are pretty bullish on Meituan. All that being said, Alibaba is still a 2,000 pound elephant, and if it decides to go all in, Meituan is definitely going to suffer. So even though they both sound pretty bullish about Meituan's long-term future, but both of them decided to stay out due to the level of uncertainty. So my personal view actually stays the same. I believe that given the recent adoption and amplification of the instant retail consumption habit, the market will become big enough to consolidate to two main players with good enough unit economics, and my bet is actually in both because I own both Alibaba and Meituan. And in order for that to happen, I think the baseline thesis is that JD will have to give way and they will suffer in the meantime as Alibaba and Meituan absorb the rest of the market. So I bet on both because I do want to participate in the entire market growth and earnings. And my baseline view is that Meituan will still be the superior business with a 60-40 split in the long term. My bigger concern now is more so about how far Alibaba will want to push the gas pedal and how much more shareholder capital it will be willing to light on fire before equilibrium. And also, when would Alibaba's shareholder base actually come back and to question the management into looking at the numbers and to have a more logical fight. You will have to really relinquish control to the capital deployment decisions of the management team. And on a side note, I think it's a good thing that Alibaba will have a lot of opportunity cost decisions and discussions on their existing capital, especially with this whole AI and cloud tailwind, which will not give them a lot of leeway to burn capital frivolously. So the bigger consideration, at least for myself right now, is whether I want to continue deploying capital to the one that is already beaten down and how I should think about the ultimate position sizing. And the ongoing conversation about being early versus coming in at a later stage, but in a much more sensible climate and not be gasping for air before every earnings call, thinking about how much money they've lost or they're going to lose based on guidance. And this decision is also adjacent to whether we want to sell first and to come back later on. And yes, for now, I'm still holding on to my position. I have 1,400 shares of the 3690 in the Hong Kong exchange with a $133 average price. It's a 6.56% exposure on value on a portfolio basis with a negative 20% unrealized loss. I still believe that it can double easily, but the consideration here is much more about how long would it take and will the CAGR be something acceptable? Or should I come in later, at what price, and what's the expected growth rates? So I hope that this sharing gives you a little bit more appreciation and understanding from the mainland side of things and how those investors think about this recent delivery war. And feel free to leave in the comment section down below on what you think of Meituan. Do you own them today? Are you intending to own them? And what's your thought process behind it? So with that in mind, I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.